Well, good morning, everyone. Welcome to Trading a Smaller Account. I'm going incognito today because only a tiny sliver of my camera has decided to work, but I'm still here in beautiful, smoky Chicago and looking forward to being back in Salt Lake City tomorrow. But today we're talking trading a smaller account. We have lots to talk about as always. It's good to see all the usual suspects along with some new folks here in the chat. So hello to Paul and Marcus and Dom and Alfred and Josh and Life in the Fast Lane. I've got to love some of these handles, and Lori and Kevin and Sharon and Will and the rest of the gang. Thanks for helping bring this class to life. If you're new, feel free to type a greeting into the chat so that we can welcome you. We link arms here every Monday and Friday at high noon Eastern. We've got Kevin Horner with us in the chat. He's a friend and a fellow coach, and we are delighted that he is here with us. He understands all of these trading strategies that we're talking about and then some. So if you have any questions, don't hesitate to type them into the chat, and either Kevin or I will get back with you. If you are not following us in the land of both LinkedIn and X, you are missing out. On X, you can find us at Kevin Horner CS and at Barb Armstrong CS. So look us up and give us a follow there. Just as a quick reminder, we do a lot of options trades in this class. Know that options carry a high level of risk and aren't suitable for all investors. We look at managing our risk and talking about that in class, and we'll do that again today. We do our example trades on the Paper Money software application on the Thinkorswim desktop platform. We use Paper Money, which has some nuances and differences between it and a live account. First, if you blow the account up, you can just add more money. In Paper Money, you can't do that as easily in a live account. But also short option positions will never be assigned early in Paper Money, and that can happen in a live account. Have I seen it happen? I have. So, this is why we mention it frequently. So we do a quick market overview in this class, and then we focus on placing new example trades and then following up on the trades we've placed. We don't do an in-depth market overview because Kevin Horner does a fabulous job at the market open at 9:30 Eastern in a class called Trader Talks 4 days a week in going over, all of that stuff. So someone's asking if I'll review some trades, and we may look at a couple of those today, but that won't be our focus today, but I will go over those on Friday. Okay, I think we'll go over one of those, but just so stay tuned for that. Because trade management is an important part of managing a portfolio. So let's have a quick look at what's going on in the market. So the S&P 500 had this huge run to the upside in the neighborhood of 20%, and it's been kind of setting up a bit of a pennant pattern. And it's still like within this pennant pattern, but we're within, if you had a really good arm, I'd say a stone's throw of the all-time highs here. So it's pretty hard to characterize this as anything other than an uptrending pattern with a period of consolidation happening. Okay, when we look at our NASDAQ, again, we have this dramatic rise to the upside. And although I'd drawn a pennant and it's kind of broken below that, so you might say, well, that line needs an update, and I don't disagree. I'm going to make this a straight line. So our pennant pattern is kind of evolving, isn't it? Some might call that a bull flag and a stiff wind, but really it's been consolidating here for about a month and a half since the beginning of June. Okay. And then how about our small caps? It's a little more even looking pattern, this one, isn't it? But again, we've got a bit of a pennant, some might say, setting up here. But overall, uptrending, the Russell up 19% year to date. And if we go back and look at the NASDAQ, it's up 14%, the S&P up 9 and change. And then the last one, if we look at the Dow, it's up 8%, but after coming down, has had this big run to the upside and consolidating as well, looking like it's coming back to this 30-day moving average today. And then if we look at our volatility index, it's still sitting comfortably under 20, at 17.6 and falling today, down 6% today. Yeah. So Bill is saying JB is gone this week. He's not going to get his quota of being yelled at. I can take you out to the woodshed if need be. So there we go. And this class, if you are new to this class, we started the year with $25,000. Our goal this year was to earn, our initial goal was to earn $100 a week over the course of the year. So our goal was to finish the year at 30,000, 200. And we've exceeded that goal. So we set a new goal to earn on average 200 a week over the course of the year. And so we've got, 55,000 still to go. Okay. Yeah, welcome, Janet. She's saying she's new here. And, we do cover a lot in this class. So the one thing I will say is if it feels a bit like you're drinking out of a fire hose, just keep coming back. Um, so the first one we're going to look at today is CrowdStrike. Now, CrowdStrike is up a modest 74% year to date. I say that tongue in cheek because that's a pretty extraordinary return. And some, just did a 4-for-1 split. So, which means this stock used to cost 4 times as much as it does now. So it would have been sitting like over $800 a share, which would put it out of a lot of, like, if you got a smaller account, then that trading that might be out of your snack bracket. Okay, so when they do this 4-for-1 split, it comes within reach for more people to trade. And what we're seeing is we still have this uptrend. It's come out, it pulled back a bit. Some might see this as a bull flag. And today we've got, we had an inverted hammer. Today another inverted hammer, but it's trading above Friday's candle. And when we look at Friday's candle, this is, it has a red outline because it closed lower than the day before, but it opened lower and closed higher, which is a bit of a bullish sign. And then we look at today and it's continuing to move to the upside. So one might look at that and say, well, maybe we could do, a swing trade on this just up to the previous high. It's at 204 up to 217. We could do that with stock if we had some money in our account. And, when we look at our account, how much have we got? We've got 25 of our 30,000. We've got 25,000 of it sitting in cash. So we could do that. And then you might say, well, like, would the juice be worth the squeeze? Like if I made my target 217, how much could I make? Well, if I come back and I do the math, let me come up here and I'll close this. And we're going to turn this into a calculator. So if I say, well, if I sold the 217, if I put my target at 217 and I'm buying at 204, let's call it 70, then the most I can make on this is $12.30 on an investment of 204. So I'm going to divide that by 204, say 60. So that's a 6% return, and we'd only expect to be in this trade for a few days. So, Paul, you're right. It's about 5%. But if we have, 25,000 sitting there not earning any money for us, maybe, 6% beats a poke in the eye with a sharp stick, as I like to say. Our max position size in this class is $5,000. So, we can't do a buy right where we buy the stock and sell a covered call because that would be a $21,000 position. And even though we have 25,000 in our account, we don't want to put all of our eggs, that's too many eggs in one basket, but we could just buy a few shares. So if I said, okay, it's 204.70, oops, dang it. So 5,000 divided by, let's call it 204. So we could buy 24 shares. Yes. So we're going to call that a swing trade. Okay. So we're just buying some shares of stock, 25, and saying, hey, if it can go up to 217, the previous high, we're good to go. And that's honoring our position sizing rule. Now, the second part of position sizing is we don't want to risk more than about $500 on any one trade. So at 199.52 is our recent low. So we take our 199.52 and we're going to multiply that by 0.97. We're going to say if it goes 3% below that, and we're going to buy 24 shares. Okay, so 199.52 times 0.97. So that's going to be our stop because our recent low is this low here. Now we could put it 3% below here. We're just taking more risk per share. So then our stop would be at 193.53. And we're buying at what? 204. So we're risking about $10 a share. Okay, so if we're saying, okay, we're risking $10 a share, so I'm going to subtract this minus my 204.65. Oh, shoot, I can't type today. 204.60 minus 193.53. Okay, I'm going to do this on my little calculator here because obviously it's Monday and I can't operate this calculator. So 204.58 minus 193.53. Okay, so we're risking $11 a share times 25 shares, 276. So now keep in mind when we have a stop loss, it doesn't guarantee that we're going to get out at the price requested, right? But it gives us something to aim for. So how do we put this in? We're going to come to our trade tab. We may look at Target today, just spoiler alert. We're going to right click on this. We're going to buy custom with an OCO bracket because we're going to put our target in, and our target is 217. Our target's 217. And our exit's going to be at 193.53. $193.53. Going to make both of these good till canceled. And of course, we can't do 100 shares here. So we're going to make this. Let me see if I can bring this. Here we go. We're going to make this 25 shares. And then when I click anywhere on these lines, it'll even them up. So we're buying 25 shares. We're investing $5,113. So that's, we're cool with that. We want to exit if it goes up by $12 or down by 11. Okay, so we're good with that. We're going to put this in our stock with targets. Now, Trader Joe said, why not do a long call vertical? So we're going to compare this to a long call vertical, LCV standing for long call vertical. So what's the appeal of a long call vertical? Well, the appeal of a long call vertical is that we're here and we're saying, we believe based on our superlative technical analysis, that this stock is going to continue to go up. It's currently sitting at 204. And our preference in this class tends to be to try and bracket the current price. So if it's at 204, could we buy the 205? And the idea here, and the more bullish you are, and there's nothing to say that you can't buy the 205 and sell the 210 if you're really bullish, but could we buy the 205 call? So when we buy a call, what does it mean? It means it gives us the right to buy the shares at 205. And it's, or sorry, if we're buying our call at say 200. And then we're selling a call at 205. Now, why do we want to do that? Well, we're going to cap our gain, but it makes it more affordable. And so if we sell a call at 205, this makes the long call vertical. So the most we can make on this is the difference between the strikes are $5, what minus what we pay to get in. And our typical goal is to make a 50% return. So if we're paying 250 to get in, then we'd want to exit at 375. And then we've made our 50%. So let's come out to the trade tab. And if we're really bullish, we could, buy the 205 and sell the 210 because our expectation is that it's gonna go up past 217, right? Right. So, but this means it has to move less. If we buy the 200 and sell the and we want to make this 205, it's almost at 205. So what this means is it doesn't have to move very far in order for us to end up with our max gain. I'm going to move this quantity back. I'm on a little portable monitor, so it's just squishing things up here. So this is at 263. So then if we multiply 263 times 1.5, that's about 390 something, right? Times 1.5. That's 395. And so you might say, well, why would I get out at 395 if I can hang in there to $5, then I could make 237 instead of just 130. It's like, well, we don't want to be greedy. And you tend to have to stay in almost right till expiration to make the whole thing. And we're 29 cents away from the top strike. So if it goes above that and then stays there, um, we're more likely to get to our target price perhaps a little faster. And of course, we're live in the market and I'm going to make this 375. It's currently 250. We're willing to risk 500. So we're going to do two of these. We're going to come to first trigger sequence, right click, opposite order. We're going to make our exit 375. Why is that? Because that would be a 50% gain. And that's our target for this example trade. And so we're going to put this in our long call vertical group, and we're going to compare this to the stock trade with a target, with a swing target. We'll just see how that goes. Okay, and when we put these notes in here, this is just a note from us to us. Okay, and if you're saying, well, once I put the note in, how do I see it? If you come to the monitor tab and come to your working orders, you can see these little like note cards here. So if I click on that, it says, oh, you wanted to compare this to the stock trade. And so I'm going to save that. And if I come down here to the stock trade, it's saying, oh, compare it to the long call vertical. Okay. Yeah, so if we could make 50% in, 2 or 3 weeks, like the longest we'll be in this is, August 21st. We're going to be out prior to that. So the next time you meet with your friends to watch a ball game or something, and you say, can you believe this woman suggested I get out with a meager 50% return in a month, or less? Like they're going to be throwing the Cheetos at you. Okay, so there's CrowdStrike. So we've done 2 trades on CrowdStrike, and we're going to compare those. Now, Kevin is going to be laughing because Kevin and I were together in Chicago yesterday, and we were talking about IREN. So IREN is a company based in Australia. And how do I know that? Because I went to the Analyze tab. If you scroll up, it says here, New South Wales, This company is based in Sydney, Australia. It was originally or formerly known as Iris Energy, changed its name to Iren in November of 2024. It is part of the tech sector. And how do I know that? Because it says right here, tech sector. And, it's up dramatically today. So if we look at this, you say, oh, that's a nice little pop. Well, it was 15% the last time I looked at it. It's now up almost 20%. And if you come over here and look at the news, you can see, why Iron is popping today. It says here, why is Iron stock jumping on Monday? When you click on that, it'll bring up some information. So they have raised their cloud target to over 4 billion. So good news has come out for Iron. But what we've seen is over the last 9 months, this looks like it's setting up a bit of a triple bottom, and it's been moving between $30 and $60. Like, it's one thing if it's moving between 300 and 330, like 30 to 60 is 100% movement. But so what could we do with this that might be modest, and what could we do with this that might be more aggressive? Well, if you wanted to do something a little more conservative, you could say, well, hey, its recent bottom, like this 9-month low is $30.76. Could I sell a short put vertical at say 30? Like this last time it came down, the low was 32.22. And so this is kind of neutral to bullish. It's currently trading at $40. I don't even know if we can do this anymore. I looked at this first thing this morning. We'd have to come out to Iron and maybe bring up like 40 strikes to even get down to that 30 strike. Yeah, 45 strikes. So if we look at the 30, have we got volume? 27,000 contracts. So is this liquid? And I've got an example trading plan, and I'll show you where that is in a minute. But one of our guidelines, if we're trading a short put vertical, is okay, does it trade 1 million shares a day or more? Check. Are there at least 20 times the number of contracts we want to trade? Check. At 27,000, is there a tight bid-ask spread less than 10%? Check. So check, check, check. So the next question is the juice worth the squeeze? Like, can I get enough out of this? If I come to 29, I'd get 28 cents. If I come to 28, I'm getting 52 cents. So I'm not getting double, even though I'm doubling the risk, but I'm risking, and this is for the monthlies, I'm risking $1.48 to make 52. And so if you say, okay, well, is that worth it? So you take 52 and you divide it by your 148, because we're risking $2 minus the credit. So that's a 35% return on risk. Now, our trading plan says, hey, if we're going to be in this till August, potentially till August 21st is the monthly, that's 32 days. We want at least a 32% return. Are we getting that? We are. We're getting a potential return of 35%. So we're going to say, okay, well, if I wanted to take that trade, and then the other question you might say is like, well, what's the probability on this thing? Let's see if I can bring this down. Things all squished up here. Here's my 30 strike. I've got a delta of 19, which some will use as a rule of thumb. Like what delta actually means is if the stock goes down by $1, the value of this strike goes up by 19 cents. But the probability of it being in the money, and this is a wider variation than we typically see, is 32%. So that means you've got a 68% chance that this is going to expire worthless. Okay, and it's already trading $10 above our strike. So if we say, okay, we're cool with that. So we're going to do 3 contracts. What does that mean? It means we're risking $441. Is that less than 500? It is. So are we okay with that? We are. And then we always put an exit in before we place our trade. And so we're going to create an opposite order and say, hey, when this thing is worth 10 cents, let's take our risk off the table and buy it back. So that's what we're going to do. Now, this one, I thought I'd do some, comparison trades today. So this we're going to put in our short put vertical bucket, and this we're going to compare to a buy right covered call. Because this stock costs $40, so we could afford to buy 100 shares of this. Okay, so we've set that one up. We got paid 51 cents, so we're good to go there. Now, what else might we do? Well, we could say, here's our recent low. If we bought 100 shares, where might we want to exit? And this low was 32.22, or we might use this 31.50 line here. We could use that too. So, but if we said our recent low was 32.22, if we bought the stock and it didn't work out and it went 3% below that 32.22 times 0.97. So if it goes below 31.25, that's going to be our stop. And this stock is fairly volatile. Well, it's not fairly volatile. I'm not being honest about that. It's really volatile. How do I know that? Well, the implied volatility is 140% for August, and the expected swing is up or down $14 on a $40 stock. So could we come out here and say, well, like it's trading at 40. If we sold the 45 call and bought the shares at 40 and said, if it goes up $5, and again, trades more than 1 million shares a day, check. Bid-ask spread 20 cents on a 4 something option, check. Almost 5,000 contracts. Or, we could even come up here and say, instead of getting paid $4 to get called out at 45, we could get paid $3 and, say we could be called out at 50. Well, does that make sense? Well, this has been trading between 30 and 60. So here's our 50 is up here. Let me get a straight line. So like, does that look that crazy? And, and then once no, don't, okay. I don't know why this keeps like double tagging me. Okay, edit. We're going to make this 50. I was going to go for the 45, but now that it keeps going up today. So we're going to show this on the right and say, here's our buy right covered call for August 21st. And so when we look at the stock, we're going to know that our plan is to get called out at 50. And if we get called out at $50, are we going to be sad? No, we're going to be thrilled. We're going to be thrilled because how much will we have made? Well, let's figure it out. So if we come here to 50, we're still getting paid 297 to 305. So we're looking to buy covered stock. That's what we call it in Thinkorswim terms. So we're paying 36.93. So what's the most we can make on this? Is 50 minus that 36, call it 36.90. So we can make $13.10 a share, more or less. Call it $13 a share. So if I can make $13 a share on a $36 investment, and we'll look at the probability of this, 13 divided by 37. That's a 35% return. Now, what's the probability of that happening? Well, again, if we come back, let me get rid of this, and look at this, and I'm sorry, let's just come back here. If we come back and look at this, the probability is 36%. And it's saying you have a 22% probability. This is probability of in the money. This is probability of touching. You have a 50% probability of it coming up and hitting it, a 22% of it being in the money at expiration in 32 days. Now, if we sold the 45, you've got a 72% chance of it hitting and a 32% chance of it being in the money. And so actually we could do one of each if we wanted to compare them, because this is but you know, it's a $4,000 investment. So we're just going to do one. We're going to do this one at 50. And we're going to buy covered stock. And then to put our exit in, we both have to buy back the call and then sell the stock. So we're going to create an opposite order. We're going to make it a market order that's good till canceled. And our exit was at $31.25. Less than 31.25. Oh, yeah, we could do a long put. Yeah, Sam, that's not a bad idea. Let's look at that. 31.25. I'm going to put that in. But if we look at a long put at it, one of the challenges with this, I will say, and let's just shrink this up. If I come out to 31, that put is still going to cost me $250. But then I'm guaranteed, you know, if we spend that $250, so this is buying a put instead of putting in a stop loss order. When we buy the put, we have the right to sell the stock at $31 no matter what. And so we could do that. And we have done that on occasion. Because the stock is so volatile, the cost of the options, and what did we say ours was 31.25. So we'd want to be around here if we're trying to do apples to apples. And then we're paying $240 for this as well. So because of the volatility pumping the price up, we're just going to go with our original order. But I really like the way you're thinking. So so here's our order, confirm and send. And we're gonna put this in our buy rights, and we're going to compare this to the short put vertical. Okay. Yeah, and so you're using what you've gained on what you've earned on the call to buy the put. Yes, and that's called collaring the position. Yeah. Okay. Okay, so we've now done 2 trades on iron. And what I want to do is I want to show you where you can access these example trading plans. So if you just bring a window up, and we're going to go to Trader Talks. And if you haven't already subscribed, you're going to want to do this. And when you come to playlists, you're going to scroll down to the trade management mini sessions. Now, the first group is a big group of short videos on different candlestick patterns. You know, we talked about this inverted hammer followed by a hammer. If these are new terms for you, like this video is 4 minutes long, this one's 5 minutes long, like there's a whole pile of them. You can catch those. But then here's some example trading plans. So, you know, here's an example trading plan for the buy right covered call. We did one of those today. We did a long call vertical. So here's an example trading plan for a long call vertical. And then here's an example trading plan for a short put vertical. And these short videos provide you with a framework from which you can create your own example trading plan. Okay. Okay. Alrighty. So just let me scroll through. So somebody made the comment, that's a poor payout for a short put vertical. If you look at our example trading plan, the way we've tried to make it kind of a way to compare apples and oranges or different strike expirations is if we're coming out 32 days, we want at least a 32% return on risk. And if we're going out 40 days, which we seldom would, we'd want a 40% return on our risk. And it's pretty typical with a short put vertical that you're risking more than you're making, because if you're putting it below a support level, it's a higher probability trade, but lower return, but it's less directional. So if we look at on IREN, if we come back to Thinkorswim, I've got to watch my time here. So if we come back and we look at this, I sold as for our example trade here, we sold the 30 strike. So our strike is down here. Okay. So as long as it stays above this, so if it continues to go up, we're happy campers. Okay. If it goes sideways, if it starts going sideways, we're happy campers. It's trading at $40. So we can even be a little bit wrong in that it can come all the way back down here to this 31.5. We still have a successful trade. It's only if it goes below 30 that our trade is no longer profitable, given we're close to expiration, because I'm not taking, changes in volatility into account, but, we've got time on our side, and every day that we're in this trade, time decay is ticking away at the value of this. So this is less directional. So when you have a less directional trade, it tends to um, have a lower return. Now, when we look at CrowdStrike, which was the other one where we did a long call vertical, we happen to place our strikes at 200 and 204. So it's kind of bracketing where this is now. But, some traders, because it would have been less expensive, if you did say the 205 and the 210, either way, it has to go through both strikes and stay there. So it is a more directional trade. But we're looking for a higher return on risk on that. So we're basically in that one, we were risking 250 to have the opportunity to make 250. But we're saying we would be happy with 50%. Okay. So I don't know if that sheds a little light on that. Yeah, so somebody else said, when we were doing that 205, what about the 202.50? So if we come back to CrowdStrike, there was a 202.50. These have just more recently become available. And so they still have, a number of contracts here. Let me just see the bid and bid-ask spread. So the bid-ask spread is probably not bad on this, but they tend to be, this one, we just have more liquidity here because these have been available longer. There are more contracts. And that's why I chose the $5 wide spread. If you're just looking for the logic in that. Um, yeah. Prices below both moving averages. That's probably on the IREN trade. And so support and resistance, when we look at support and resistance, when something's going sideways, your stock is going to weave through your moving averages, which is exactly what this stock has been doing. It's been going, down below the 10 and the 30 and then up above and then down below and then up above and then like dolphins swimming in the ocean. They're above and then they're below and then they're above and then they're below. So we don't have as part of the rules for a buy right or a short put vertical, it is not part of our rules that it be trading above a moving average. What we do want with a short put vertical is we want it trading above the support level that we're selling. And we want our strike to be below that support level. So when we play I Spy with my little eye on IREN, we're saying, okay, here's our support level around 31.50. We're selling the 30 strike. Is it above that? Yeah, it's above that by $10 and moving with conviction. Now, could we still be wrong? Sure. Yeah. But it's like this isn't a new pattern, my friends. This has been in this sideways range since at least November. Let's go back a little further. Yeah. It was uptrending and then it started going sideways. And so if it comes up and hits this, like, break out the champagne. Yeah, I stayed at a hotel in San Diego recently where you could buy champagne out of a vending machine. I thought that was extremely cool. Just saying. Okay, so we're going to have to wrap up, but there's a couple of other stocks had we had more time that we might have looked at. We may come back to these on Friday. One is Target. And Target, it's up 43% year to date. Like that's extraordinary for I don't know if this is considered consumer discretionary, because they do sell groceries. Yeah, it's considered a staple. There you go. They sell a lot of stuff you don't really need as well, but Coke is considered a staple, and I would argue that we don't really need Coke, but there we go. Anyway, it's been uptrending. And, so could we have looked at a bullish strategy there? Well, we could have. So like we're just going to stick that in our back pocket. Maybe we'll come back and look at that. And JP Morgan, I say I see a bit of an inverted head and shoulders here, and then it broke out. And the financials have been kind of crushing it. It broke out, kind of hung out for a bit and moving to the upside, bit of a bull flag happening here. We may want to wait for a close above the high of the low day. But, we may want to just kind of stick this one in our back pocket for an example trade and keep our eye on that. So guys, thank you for joining me today. Josh is saying Diet Coke 100%. Is that a staple? I have one in my fridge here, guys, so there you go. Anyway, here's my ask of you as we wrap things up. If you have not hit the like button, if you found this content valuable, please hit the like button. It helps move things up in the YouTube algorithm so more people can find this content. Subscribe to the channel if you haven't done that already. Kevin is posting lots of charts on the daily. You don't want to miss what Kevin is posting, so follow him on X and LinkedIn at Kevin Horner CS. Follow me as well at Barb Armstrong CS. Take care of yourselves. Get out there and hug someone you love and stay tuned because up next is whoever is filling in for James Boyd today. You won't want to miss it. And I will see you in a webcast coming up soon. Take care, everyone. Bye for now.